Welcome. This is Mark Sobel. I'm the U.S. Chair, OMFIF. Today, I'm looking forward to a discussion of yesterday's FOMC meeting and the Fed stance overall with two of my favorite people and Bostonians, Steve Cicchetti and Christopher Smart. Steve is one of America's foremost monetary policy scholars and gurus. He's now a professor at Brandeis. In a distinguished career, he's also served as the head of the Monetary and Economic Department at the BIS, an executive vice president and director of research at the New York Fed, and a slew of other achievements. And he's also one of the main authors of the outstanding must-read Money, Banking, and Financial Markets blog, which everybody should have bookmarked and read religiously. Christopher Smart is the chief global strategist and head of the Barings Investment Institute. From 2013 to 2015, he served as special assistant to President Obama at the National Economic Council and the National Security Council, where he was principal advisor on trade, investment, and a wide range of global economic activities. Christopher also spent 4 years as Deputy Assistant Secretary of the Treasury, where he led the response to the European financial crisis and had to put up with me. Prior to his government service, he managed emerging markets and international portfolios. Welcome, and so let's dig in. I always start a post-FOMC session asking, what's your take on yesterday's FOMC, the dots, the presser, what stands out? Did anything surprise you? Was it a hawkish message? Steve, let's start with you.
Thanks, Mark. First, thank you very much for the invitation. It's always a pleasure to speak with you, and as it has been over the years. I'd say that I had four main takeaways. The first one is the one that's been in the press, which is that the committee slowly realizing that tightening's coming sooner rather than later, and that the median participant now sees two increases in 2023. I guess I'll be surprised if it isn't even sooner than that. The second one is about inflation forecasts for 2021 and 2022, which I think are still quite optimistic. The forecast of a 3.4% full year inflation means that the remainder of this year is going to be something just over 2%. So that is that they're saying that the transitory part of inflation, what they're calling transitory above their goal, is almost over, and it's only going to be very slightly above their longer run goal of 2% for the rest of this year and into 2022. The third one is that uncertainty is high and continues to increase. This is uncertainty about both growth and inflation, and it rose if you look at the details of the Summary of Economic Projections, the SEP. This seems right to me, and it's likely to slow them down. The natural reaction to this is going to be caution on their part. The fourth one, which has gotten very little press, I think, is important as well, and that's the increase in the overnight repurchase repo rate and the interest on excess reserves, or what they're calling on interest on reserve balances. They decided to change the name by 5 basis points. Since reserves are about $4 trillion and the ONRRP has been running about 500 billion, this increases the payments to banks and money market funds by an aggregate of about $2.25 billion per year. The question is, why are they doing this? They claim it's to keep the funds rate in their range, so it's a technical adjustment. But if they didn't oversupply reserves through their asset purchases, there wouldn't be a need to absorb so much liquidity. So I think that that's actually an interesting thing. It's beyond technical. It has to do with a lot of policy issues that we might have a chance to talk about. But those are my four main takeaways.
Christopher.
Well, thank you for the invitation to be here. Thank you, Mark, for that generous introduction. My role with particularly the European response would have been much sadder without my partnership with you through those difficult and adventuresome years. My take, at least on yesterday's meeting, and I've just been through a number of meetings with my colleagues at Barings debating this out, so it's a little bit fresh in my mind. It's very much a typical Rorschach test of market participants who look at the same thing, look at the same statement, and see the same press conference, and emerge with diametrically opposite views of whether or not this was a hawkish or a dovish press conference or a dovish Fed meeting. I come at it from a camp of that this was still essentially dovish. It was a shock that shouldn't have shocked us, in the sense that we weren't expecting anything to come out of this meeting. And yet we got some new dots. We got some changes in the overnight reserve rate levels. But I think the message is very consistent what we've had throughout the crisis. I think Jay Powell was very eager to show that he was, first of all, it sounds very clear to me he would like to eliminate the dot plot if he could. And every time he gets a chance to, he says, we don't talk about it. It's everybody's individual views. You shouldn't pay any attention to it. But it's clear that he's starting to move, take a step or two down what is a very long path back to normalization. But it's really a step or two. And what I heard mostly through the press conference was very uncertain times, very messy data. We're going to err on the side of supportiveness rather than anything else. We've never been through anything like this before. And I actually posed the question in an opposite way, which is, if we really were in a world where rates did not rise until the end of 2023, given all of the monetary and fiscal support that governments globally have put into the economy, and we're not on a path to some normalization by then, it's a pretty scary world. And so, at some point we have to start moving down this path. Markets have to get adjusted to that kind of a direction. And I thought, he's never going to hit it right for everybody. But I thought, at least for me, it was, threading the needle pretty well. And it seems to me that markets sold off a little bit yesterday, have bounced back a little bit today. And I think, we'll move on from here towards, baby steps towards normalization.
Okay, well, thank you for that. It sounds to me, if I'm reading things correctly, that the Fed did a better job of threading the needle for Christopher than Steve, but let's explore that. So there's obviously lots of talk about labor markets, inflation, and then taper, especially given the comments about substantial further progress towards goals of price stability and maximum employment are needed for tapering. So let's start with labor markets. Labor market indicators are pretty confusing, at least for a simple person such as myself. Unemployment's at 5.8. It's well above NAIRU. U6 is still around 10%. The last two payroll readings were lower than expected, but you can see signs everywhere. Businesses want workers. Job openings are record highs. Workers are able to demand much higher wages. So, Christopher, what do you make of the labor market confusion? Are they tight as a drum, or is there lots of slack?
I think, you pointed it out, and I think Jay Powell pointed it out, these are very confusing times. Normally, in the best of times, we have lots of problems with the labor measures, with the surveys. What do we look at? What do we not look at? It would be shocking if we thought these numbers were more reliable or more clear in terms of the picture they're painting. Excuse me. I have a colleague who has described this period, normally when we think of capacity and inflationary pressures, we're thinking of an economy that is strong and reaching its capacity. My view is that this is an economy that is weak and has been caught by surprise. And you see that in certain sectors, particularly hospitality and the COVID-related sectors, so-called, where jobs are there. There is intense demand for waiters and short order cooks and bellhops, but not necessarily enough bodies to fill those jobs, because the people who were let go 6, 12, 18 months ago have either moved or getting unemployment benefits, can't get childcare. It would be, it's to me perfectly explainable why there is a moment right now where there are a lot of unemployed people and a lot of job openings. Those things don't settle out, the markets don't clear on labor the way they do in the Treasury market, at least most days in the Treasury market. And so I think that is why we have that confusion and that noisiness around it. I still focus most of all on the labor participation rate, which remains very low compared to the pre-crisis levels, and that there are people who just left the labor force entirely. Over time will come back, but it's not going to be, it'll be over months and maybe the next year or two, and that is going to give us, that will sort of ultimately lead to wages being more restrained. And I think that's what the Fed is looking towards. Last thing I'll say is, I think it's remarkable the last couple of press conferences you've seen Jay Powell focus a lot on inequality, on not just the overall unemployment rate, but the Black employment rate, the female unemployment rate, the Hispanic unemployment rate, and a real effort, not that those are going to become targets, but they are sub-targets in a way that will leave him much more dovish for longer.
Thank you for that. Steve, what would you like to add, if anything, on labor markets?
I think, first of all, I agree with Christopher that the data is extremely confusing, and the data is extremely confusing. It's hard to know what to make of it. I'll even add to the confusion that that I was looking at the not seasonally adjusted labor market data as well as the seasonally adjusted labor market data, and it's to see people, you see 1 million jobs added on the not seasonally adjusted data, but it gets seasonally adjusted way down. And so then sort of, what are you supposed to think of that? Because is this really sort of a normal spring, summer? Seems not normal to me. I don't know. I'll also just add that a story, though, that I was actually in my car driving, listening to the radio, amazingly. And there was a Boston bar owner saying that he needed bartenders, and he'd never had really trouble getting bartenders. So he went down the street to a store to buy a help wanted sign, and they were out of help wanted signs. So so I thought that was sort of an interesting indicator, but I think it's really an issue, as Christopher says, about matching and keeping things about, we have a lot of openings, we have a lot of people looking for work. Are people able to find what they want under the current circumstances and what works for them? We're not quite sure what the employment population ratio is going to do. And so it's really, really it's very hard to know what to make of the numbers.
But I do like the idea of introducing a new indicator of sales of help wanted signs.
Okay, well, inflation also confusing. There are debates about base effect supply constraints, but then there's the positive output gap argument. Presumably what we should be worried about in inflation is if it is born of overheating, if there's second round wage effects and the like. So I have a bunch of questions. Is the rise in prices transitory or more persistent? I was just out on the West Coast touring around an area of fossil beds where time was measured in millions of years. So, so I'm not sure what is transitory or not. And then there's the Larry Summers arguments about positive output gaps and excess stimulus triggering high inflation, or the Bill Dudley argument that the Fed, under its new flexible average inflation framework, will react too late and get behind the curve. Steve, a whole range of questions for you. Tell us about inflation.
Yeah. First of all, I guess relative to those fossils, we're all transitory. So that does give you a sort of slightly different perspective. Let me make two quick points.
I don't think even Keynes had that in mind when he was talking about the long run.
Right. That's right. Yeah. That's right, Christopher. This is beyond dead, I think, though, in some sense. 2 points, one about inflation and one about policy. On inflation, I think there are some reasons for concern. Inflation remains under control for now. The measures that I follow, that are these sort of slightly esoteric trimmed means, are still in the sort of 2% range. Obviously, there's this permanent gap between the PCE and the CPI that's about 0.3, but they still seem to be around the target, close enough for my taste, once you get rid of used car prices and stuff. But aggregate demand stimulus is extremely large. Kim Schoenholtz and I in our blog have have done a back of the envelope calculation and estimated that this year's discretionary fiscal stimulus is on the order of 10% of GDP. That's by far the largest since World War II. When we had a stimulus that was 1/3 this size in the 1960s, that came from the Vietnam War and Great Society programs of the Johnson and Nixon administrations, and we had an accommodative Fed, inflation rose from a number like sort of around 2% in 1965 to more than 5% by the end of the decade. I think that people are talking a lot about the 1970s, but I think they should be focusing on the last half of the 1960s, because that's what this looks like. So will the Fed react too late? I think the shift, as you suggested, what Bill Dudley especially has been talking about, the shift from concern about deviations of employment from its maximum sustainable level to shortfalls is a commitment to forego preemptive tightening. So yes, they're going to be accommodative, and yes, they're going to be late, and it's all by design. So that's what they've committed to do. Now, let me just make one more quick point on policy. I wish the Fed would convey their reaction function, not just for interest rates, but for balance sheet policy. Jay Powell was very vague about this. I think not, and I don't blame him, because I think it's the committee overall that hasn't focused on this. What constellation of data is going to lead them to do what? On interest rates, we have some sense of what that might be during normal times. Now I'd say we have very little. Instead, we have these vague statements about that they're going to do what's appropriate to support the economy, allowing inflation to overshoot, but then ensuring it doesn't go too far, whatever that means. And so I think that's where I would really I would really focus my comments, is that, and suggest that we need more we need more guidance, so that Christopher and his colleagues and others, his peers elsewhere in the market, aren't sitting there speculating about this, but have much more of a sense of what data is going to drive policy.
We would love more data and guidance and help in what we do. The question, I think, for me is, having sat sort of in a markets role and also in a government role, would we trust the guidance that they were giving us? Because I think they are also mere mortals in many ways, and is equally susceptible to misreading the data, getting to a point. We saw this last time around where they kind of said, well, when unemployment gets to X, we may start thinking of tightening. Then they painted themselves into a corner and realized they didn't want to start tightening when unemployment reached X. So I would welcome the help and guidance, but I guess the question would be, would we trust it? And on the broader inflation question, I still believe that we're living in a world where the deflationary forces of globalization, technology, and demographics remain sort of dominant. And what governments need to do is whatever they can to counter those forces. Obviously, we've had this shock. We're asking ourselves, we believe inflation is transitory. We believe over the next 12 months, certainly the base effects will start, over the next month or two to disappear, which will bring that CPI number down, I think. The sources of inflation that could surprise us, that this actually takes root and inflation gets to the 2 or 3%, maybe 4% level over the next 2 to 3 years. I mean, that has to come from commodity prices, and you've seen that in certain commodity prices. My colleagues who work in that field are concerned that the green agenda, the infrastructure agenda, is going to lead to a step up in demand for copper, for steel, for certain rare earths, and that could be a continuing set of pressures. I still think markets will respond. There will be supplies that are found, and technology will adjust to that. So I don't see that as a continuing set of pressures on inflation. A second potential source of surprise is rising wages and wage expectations. Obviously, comparing today to the 1970s and 80s is obviously full of lots of peril, not least of which we don't have very strong labor unions in most of the US, and there is this globalized labor market but I think still has a long way to play itself out. Even as China wage rates and manufacturing rates have risen and production has shifted to Southeast Asia, there are lots of other parts of the world that I believe can be brought online. I think the bigger, to me, threat that inflation may surprise us on the upside really comes from this shift, not just in the monetary regime that Steve described, but in the fiscal regime, which is that we now in Washington at least no longer have a party of balanced budgets. The Republican Party has become the party of low taxes, but not the party of low deficits. And the Democratic Party has never been the party of either of those things. And so you're likely to see more spending for longer. You're likely to see more transfers to poor people, which, as we know, if you give money to rich people, they'll save it. If you give money to poor people, they'll spend it. And that has the risk of, on a more permanent basis, generating more spending and I think more inflationary pressures in the years to come. And so that's what I'm trying to watch on the inflation side. Again, not a question we can answer this year or maybe even next year, but I think that's the risk of the world that we emerge into being fundamentally different from the one that we left.
Thank you. I think if you believe in watch what they do and not watch what they say, I'm not sure the Republicans have been the party of balanced budgets in my lifetime. But tapering, maybe
Can I
just
just add one thing, Mark, just really quick?
Please.
I hope that we don't use inflation rising from 2 to 3% as a rationale for not helping the less fortunate in our society. You didn't say that, Christopher. I'm not, but it's something that could come out of that if we're not careful.
No, but I guess I believe that if we are going to get to 3%, it's not going to be from commodities. It's not going to be from wage growth or expectations of wage growth. I mean, all of these things are interrelated, right? We had a long debate about housing prices in the US, which seem to be structurally headed higher. And that could be a fourth source of, but I guess I believe that, if we get inflation, we all want some inflation, right? And that is going to be the source of it. And to clarify Mark's point, and I'll make a mildly partisan statement here. Republicans are the party of balanced budget when they're not in office.
Let's move on to tapering. Just maybe some just quick thoughts. Some of my colleagues had thought Jackson Hole might be the time when there's the intellectual case for it is articulated. Just any thoughts for us, Steve?
Let me just make a related point first of all, just to make sure everybody knows what's going on right now about the asset purchases. They're buying $80 billion a month in treasuries and $40 billion a month in agency MBS. So I'm confused by this. The MBS seems like something you would buy if you thought there were problems in the housing market. Housing markets are booming, so why are they buying? On the treasuries, as far as I can tell, this is to a first approximation coming back in reverse repo. So what's going on right now is that the Fed's buying securities in the morning and they're repoing them back in the afternoon. And yeah, the prices may be slightly different, but it still sort of seems like a kind of weird thing to do. Maybe you can claim you're doing it at different points in the term structure and stuff, but it seems very strange. So I think that on the tapering, what we really need is more clarity on, first of all, what they are doing and what they're planning. And it's important to communicate, as I suggested a minute ago, the driving forces behind their decisions. So far, they've been vague. I wish they would be clearer in the following sense. I wish they would set out possibly a set of scenarios for economic conditions as part of their SEP that would help us clarify what's motivating the current policy, why they're buying what they are, why they're not buying more, why they're not buying less, and what it is that would trigger them to stop. And if they would do this, then markets are going to react to data, as I suggested before, and it's not going to. There's a smaller chance then of a sort of tantrum-like disruption.
I would add, that's sort of a small mystery to me as well. If the housing market is going so well, why they need to buy the agency MBS, except as you've seen through press conferences and through market reactions to press conferences, markets remain highly sensitive to the slightest sign of tightening. And again, I think yesterday was a very baby step towards tapering and tightening, and everybody freaked out for at least through the afternoon. I also, I guess I'm under the impression that before they get to that first rate hike, they need to start substantially unwinding these purchases. And so that'll be the next mild taper, maybe not a taper tantrum, but roiling of markets when they announce they're going to go from 80 to 70 or 65 and 40 to 25, that will lead to that. So I don't understand the logic of it right now, other than to keep their message as clear and strong as possible that they are there to support a recovery that is underway but is still not complete.
Right, but it is weird that you could sell them a treasury security in the morning at 10 o'clock, and at 1 o'clock you could go and repo it back.
Yes.
That just
I don't have
and that's happening right now to a very, very large degree.
Yeah.
Jay Powell is lucky that Mr. Cicchetti was not one of the journalists asking questions yesterday. So maybe we can just have a quick minute. Why the 10-year? It's been fairly quiescent. It's massive fiscal stimulus, inflation, and yet it's pretty much gone down. Is this just does it reflect the Fed purchases and the Treasury winding down as cash bounces, or is it markets just don't fight the Fed? Just any quick thoughts for us?
Well, let me start, and then Steve should of course jump in. I think my expectation at the beginning of the year was that we would be steadily marching forward towards 2%, given the recovery, the vaccines, the fiscal stimulus, the global trade volumes rising. That clearly hasn't happened. I'm puzzled by it. I mean, I think clearly part of the answer has to be the Fed and its purchases. I'm puzzled by it though, because those purchases have remained constant, and therefore maybe, without those purchases, rates would be higher. But as long as they remain constant, the level should be adjusting according to market expectations. Now, I guess the best I can do is to explain it would be to say markets are also careful and worried that this boom is temporary, that these inflationary pressures are transitory, and that we don't know what fiscal policy is going to be next year. We don't know how much of the recovery will peter out by next year, and therefore they're cautious still to price in a straight line recovery. New COVID cases in emerging markets, you can list tax increases for corporates might slow things down. There are still some question marks on the table that you could buy into the overall meta recovery story, but still have concerns about next year. So that's, to my mind, not a great answer to your question, but it's the best I can come up with.
Steve, do you have any professorial thoughts?
I'll just add one small thing. I agree with what Christopher said, and another, maybe just a way to rephrase some of it is that really all of the risks right now from the perspective of the bond market are on one side. The risks are not that the economy is going to somehow boom even more. It's that it's going to slow down. That's really what they're looking at. And so if you're going to hedge anything, you're going to hedge pessimism. You're not going to hedge optimism.
Yeah, and to that point, if I could follow up, this latest earnings season was the best earnings season since the beginning of time. And not only were expectations high, but expectations were beaten, and the market was flat. Equities just were sort of a straight line through that period of weeks so I think that kind of reflects what you just said, which is everybody knows it's great now, but everybody knows it's not going to last, and they don't know what the cruising trajectory will be or the cruising speed will be when we emerge from all of this.
Well, market profits always exceed expectations. It's usually 75% beat their expectations. I assume in a coin toss world that's kind of impossible, but what do I know? But let me just move on to one specific question for each of you, and then we'll get to the audience. I'm sensitive to time. So the question specifically for Steve is, we always talk about interest rates and taper and labor markets, et cetera, but you recently wrote a very interesting blog about the types of Fed balance sheet actions and noting that these are just classified as monetary policy when in fact that's maybe not the right way to think about it. So I wanted to give you a brief word to plug your blog and that blog in particular. So Steve.
That's very kind, Mark. So the story here is that that Paul Tucker, who is the former deputy governor of the Bank of England and the current chair of the Systemic Risk Council, and I had been talking and spending time thinking about what it is that central banks are doing. We thought it was quite unfortunate that people seem to refer to everything as QE, as sort of quantitative easing, and it's not. And so our sort of first foray into this was to suggest a five-fold categorization where balance sheets could be used for any of these things, but you should sort of tell people what you're doing. So the first is what we think of as monetary policy. That's aggregate demand stimulus to achieve price stability goals or full employment goals. The second is lender of last resort. That's why we have central banks from the beginning to lend funds to fundamentally solvent institutions or other sort of types of vehicles that are facing liquidity needs and cannot meet them in private markets. We've seen a lot of that. We've also seen market maker of last resort actions where central banks are addressing liquidity problems in specific markets. In this country, the primary, actually mostly the secondary corporate bond facility, I think is very much one of those. We also see what we call collective credit support, which is steering the flow of credit to specific sectors or regions or firms. This is something that I would hope is mostly fiscal policy, but it is being done by central banks, especially over the course of the last year and in other places since the financial crisis, since 2009. And finally, there's emergency government financing, which is to provide funds to governments directly. Actually, I believe that the Federal Reserve did this in April and May of 2020 when the Treasury's account increased by over $1 trillion over a period of less than 3 months, which looked to me like pre-funding by the Fed of Treasury activities. So our central point, though, is that these five categories seem to exist, and that central banks use them. They need a regime of some sort of framework for each one, and they should be telling us what they're doing and why they're doing it, and that would help us to both hold them accountable for what they're doing, as well as just simply understand it. For people that want more, we have more.
So Christopher, the specific question for you, you worked at Treasury, you worked at the White House, you just saw President Biden spend several days in Europe reinforcing traditional alliances and whatnot and meeting with Putin. I mean, any thoughts for market implications from this?
I think what we've been discussing earlier, it's one of the longest G7 communiques that we've seen leaders produce in memory, if not ever. And some of that is catch up, since there was no communique last year at Biarritz. 2 years ago, the G7 was canceled. And 3 years ago in Canada, President Trump sort of revoked his signature on the communique, even though it's not actually ever signed, as you know full well. So I think this was a catch-up moment where the United States really was sitting down with the other richest countries in the world and getting the agenda jump-started again. And I think it was a very market positive agenda in the sense that on the one hand, we're going to throw a lot of money at these problems for some years to come. If you search the 25-page document for the word debt, it comes up 3 or 4 times, all in the context of emerging markets and debt restructuring for those countries that may need debt relief. Nothing to do with the debt that is being piled up in the US, Japan, and Europe over the next several years. So I think it is generally very positive for what we've been talking about in terms of fiscal policy, government investment that may trigger corporate capital expenditures, which we're beginning to see, and I think will be a big area to watch in the years ahead. The other thing that I think was very important was that going into this, we're just seeing a revival of, Mark, I'm sorry, I can't remember the word you don't like, whether it's cooperation or coordination.
Coordination.
Coordination. So coordination, I think in the Sobel dictionary means that we coordinate and impose our views on our partners. Cooperation tends to be more free will, people getting together and they decide to move forward together. In any case, on issues like global tax regimes, on something as small to many people but large for the US and European economy, Airbus, Boeing, we're setting aside a lot of these irritants to the transatlantic relationship that have been there for many years. And I think that is also broadly market positive. A lot to do. Obviously, communiques don't become policy. Money doesn't get allocated by these people necessarily without their parliaments agreeing back home. But overall, I think very supportive to the next stage of growth.
Great, thank you for that. So yes, good cooperation. And in a world of average flexible communique targeting, we haven't de-anchored our word expectations. So let me turn to some audience questions, and then I've got some more. But one question, I think, Steve, you talked about fiscal policy. I think you were a bit more worried about inflation than Christopher. Hopefully I haven't mischaracterized. So what do you think should be kind of an ideal fiscal policy for going forward that helps the Fed? And are you worried about a de-anchoring of inflation expectations?
Geez, that's like, those are almost impossible questions to answer. So on fiscal policy, I think that we have no choice but to work towards infrastructure, some sort of infrastructure investment, and that infrastructure investment has to address climate risks. I think that there's just really, this is not something that can wait any longer, and borrowing from the future to do that, issuing debt to do that seems fairly straightforward. I mean, if we could go back, would I have rather seen, if somebody said, would I rather see that than the stimulus bill, or at least some part of the stimulus bill from earlier this year, the original Biden stimulus bill? I would say yes. I think that part of that was probably more than we needed, but we should have shifted it into infrastructure and climate, and that borrowing's becoming a problem. We're going to have to figure out what to do about it. I guess I'm not against raising taxes on people in order to safeguard the future of current and our current generation, the future generations. On inflation expectations and the inflation process, I think that here things are Here I do worry. I think that you gain credibility slowly and you lose it quickly, and so I think that there is some possibility that inflation expectations could rise. I mean, I worry about this average inflation targeting framework, because the average inflation targeting framework seems to rely on the idea that people's short-term inflation expectations are going to bounce around, but their long-term inflation expectations are going to stay fixed. I think that's too clever by half. And so I do worry that if the Fed were to allow inflation to go to 3% or higher than that for a significant amount of time, that people's expectations would ratchet up, and that they would have a very difficult time bringing them back to 2. Has that happened yet? Probably not. There is this question about whether or not 5-year inflation expectations from the Treasury markets, the nominal minus the tips, is actually accurate. I think those are potentially distorted by the purchase programs, so I'm not sure, but I'm not sure what else I've got. So I'm kind of stuck with that. It's clear that that's what Chair Powell was focusing on in the press conference yesterday. He also did mention that household surveys of inflation expectations are not all that reliable, because people's expectations tend to be quite adaptive. They're relying on, first of all, they don't know what inflation is, but insofar as they do know what inflation is, it's what they've just seen when they went out of their door. And that's why it's so tied to things like oil prices, gasoline prices, and prices of groceries and stuff like that. So when those things rise, people's inflation expectations rise, and that's why we saw a big jump in the last few months in household expectations, is because oil prices had gone up. So I think that on fiscal policy, we've got to do something for infrastructure. We've got to do something for climate. We have no choice. On inflation expectations, we're going to have to continue to deal with the uncertainty.
Mr. Smart.
I'm not sure I have much to add on, some of those very big questions. I will maybe add on to my previous question about the G7. It was very interesting. I know, Mark, when you were negotiating these communiques, the buzzword coming out of the last crisis was strong, balanced, and sustainable, or sustainable, balanced, and strong.
Strong, sustainable, and balanced.
Thank you. Now they have added on strong, sustainable, balanced, equitable, and sustainable, and resilient.
Inclusive.
Inclusive and resilient. So there is this sense of government's role being stretched even further to focus on inequality, and then resilience, I think, is mainly buzzword for climate kinds of investments and economic activity. But it's a tall order we're putting on governments. I think they will respond with more spending, but I think nobody's got a good answer on the debt.
Okay. I know Steve has to leave early, so I'll make sure to we're not going to run this an hour as we normally do. But let me just put forward a big catch-all question in one of my favorite terrains to ask about. Zero lower bound, reach for yield, froth, asset bubbles, and the like. That's part one. Are you worried about that? And the second component of this catch-all question is basically the Fed has responsibilities for financial stability, but that isn't formally part of the dual mandate. And then markets ructions can happen, can upset the dual mandate. To separate monetary policy from financial stability concerns, you need strong macro-prudential policy. The banks seem to have weathered the pandemic well enough, but non-banks, where the key risks emanate, aren't in the Fed's domain. And so are you satisfied with the state of American macro-prudential policy, and what more is needed? Who would like to take this one on first?
Steve, you go first.
Oh, thanks. That's very gracious.
You're welcome anytime.
So there are two big questions there. The one about zero interest rates, lower for longer, or even lower for even longer, and asset bubbles. I think there are reasons to always be concerned about leverage. I think that that's the lesson that I took away from the last 15 years, is that I should try and figure out where leverage is, root it out, and make sure that it's not too big. We haven't figured out how to do that in a very systematic way yet, even in places, and I'll come to this in a second, even in places with what I would call coherent financial stability policy, we don't have a good framework, good foundation for doing that. So I think we have to work harder to understand how to identify leverage and how to put some sort of bounds on it, and make sure that it doesn't get out of hand, because that's what creates the fragility in the system. On financial stability policy more generally, the short answer to whether or not the US has whether I'm satisfied with the state of American macroprudential policy is no, not at all. I think that's true for several reasons. The first one is that the structure of the policy doesn't really work with the Financial System Oversight Council, or whatever it's called, the FSOC. I don't think I got it quite right, but that sort of seems. I mean, yeah, they have things they can do, but it seems more like a coffee group or something. They get together and chat about problems, because the thing is that if you identify risks, you're accusing someone somewhere around the table of being incompetent, and so there's a real hesitancy for anyone in the FSOC to say, oh, X is a problem, because if X is a problem and you say it, it's either your problem and you're incompetent, or it's someone else's problem and they're incompetent. And so this is not a bureaucratic structure that seems to me that's prone to actually identifying and addressing financial stability risks. As for how we sit right now, I am worried about the banking system. I think that we've spent the last few years easing banking regulation in little tiny ways. It's sort of, death by a thousand cuts sort of thing, where we do every day somebody comes into work and does a little tiny bit to make it a little bit easier on the banks in terms of their resilience. I think this is by design. And I think that while it's nice to look at the banks right now and say that they're doing better, the question is, are they really? All of their borrowers have been very heavily supported by the government, at least a lot of them, for the last 15 months. And so what happens when that support leaves? Are people still going to be able to make payments on their loans? A lot of people are even more indebted than they were in March of 2020. And so they may not. If I were a supervisor, I'd be asking banks to increase their buffers. And that's clearly not what's going on. On non-banks, especially money market funds, I think that we've now bailed them out at least twice. If you count what happened yesterday with the ONRRP rate, we are bailing them out a third time. And I want to know why we're doing this. My view is that this is a business model that shouldn't exist. These people are banks in all but name. They should be regulated as such. We also need to do something about about mutual funds that are holding illiquid assets like corporates, municipals, and emerging market debt. And we're not doing much about that. The redemption on demand, I think, is something that creates financial stability risks there as well. So I think that we have a lot of work to do, and I hope that the current administration is able to do it. I think that there's a clear understanding in a lot of parts of the administration, among a lot of the people that we know, that the work from the financial reform from the last decade is not finished, and that the pandemic has revealed new problems, as well as we've seen old problems resurface, ones that we hadn't fixed before. Thanks.
Thank you. Christopher.
Let me just add a couple of thoughts, because I know we're maybe running short on time, but I would present a slightly, I would not disagree that we've got a lot of problems, and I think Steve's characterization of the personal, interpersonal, and bureaucratic dynamics among the FSOC members is not far from the truth, even though it's not just that you're calling out one other regulators' problems. There's so much overlap. You're usually calling out 3 different people across the table. Having said that, I would just offer the notion, the hypothetical notion of a headline that reads COVID 2008. If we had been hit with a crisis, given the financial and banking system and the leverage in the system in 2008, it would have been lights out. And I think what we have learned, I think macroprudential policy has been, maybe better than it gets a credit for over the last few years. So first of all, Dodd-Frank, the recapitalization of the banks, that's one thing. Thank you, Dodd-Frank and Mark Sobel. But the other part of it is the fact that the non-bank sector covers a whole host of dogs and cats and stray animals, including my own firm, which is very active in the high yield sector, in private loans, private debt. We actually found that in the last last year, bottom fell out of the world. Everything was tanking. Fed steps in with its old playbook. I think in a world where the banks were meant to respond, where we had a bank-centric world, we would have been in much worse shape because they would have still been pulling back. They'd have had to rebuild their capital. It would have been a much more powerful countercyclical force. We found that our funds, our clients, once the Fed stepped in and put a bid on a lot of those assets, brought in a lot of money through our funds to restore order to the markets. Didn't work great all at once. There were lots of problems with market disruptions along the way. But there are, this is my mild pitch in defense of the non-banking sector, that some of it actually has worked well and has, served a function that banks couldn't serve in a crisis. Does it need more transparency? Absolutely. Does it need more regulation in some areas? Perhaps. But I think there are some things that have been positive that worked well in this crisis that we should not try and change. And it just the point is being that the people who invest in our funds are not levered themselves, so they didn't have to cut and run. They were in many cases tied up, and then once the prices had adjusted down, they were ready to commit more money.
Well, obviously, non-banks and banks are different, and one needs to tailor the oversight accordingly, but there needs to be good prudential oversight of both, in my view. So I thank you for that. There's plenty there to discuss for the future. I'm going to wrap it up now. So I want to do 2 things. First, I would like to tell our listening audience that next week, OMFIF will be hosting Fed Week. We're going to have discussions on Monday with regional bank presidents Bullard and Kaplan on the macro outlook. We'll have discussions of digital, AI, and climate issues. And on next Friday, I'm going to chair a session with Boston Bank President Rosengren. Thank you to Steve for helping me. And we're going to discuss financial stability and the questions that I just put to you. So feel free to join at OMFIF. You can sign up for these events at the webpage. Otherwise, I just want to thank both Steve and Christopher for joining me today. I'm honored to have you. It's been a lot of fun. It's been a fast 50 minutes, and I think I'm going to send a lot of what Steve had to say to my friends at the Federal Reserve, who will listen to it with great interest, I'm sure. So thank you both for joining us today.
Thanks very much. Great to be with you.
Thank you very much, Mark. It's been a great time. Bye-bye.
Bye-bye.